All right, if you've been watching the tape lately, you know Bitcoin is getting incredibly volatile. Today on The Explainer, we're unpacking an urgent and honestly pretty complex market call from analyst James Gavretti. He's arguing that right now we are sitting right in the middle of a textbook trap setup. It's this massive clash between heavy macro structural gravity and immediate short-term daily exhaustion. Gavretti has laid out a definitive master plan for navigating this exact scenario, and we're going to break down his exact data so you can really see the architecture of this market for yourself.
Gavretti definitely doesn't mince words here. He says the trend followers are walking blindly into a liquidation cascade. I mean, the stakes right now are absolutely huge. On one side, you've got retail investors stubbornly trying to catch a falling knife. And on the other, well, you've got the smart money quietly engineering a trap.
Okay, let's dive right into this. Here's our roadmap for today. First, we'll look at the macro bear trap, then smart money versus retail. After that, we'll break down the dead cat bounce, why you should sell the relief rally, and finally, Gavretti's target for a 5-week structural bottom.
Part 1. The macro bear trap.
So the core setup right now is really defined by this massive divergence. Think of the macro time frame as gravity, right? Right now, that structural gravity is pulling heavily downward. But simultaneously, the immediate short-term daily price action, it's just completely exhausted. This creates a highly polarized environment. Things might look like an absolute steal on a Tuesday, but structurally, they're doomed by Friday. It is your textbook trap setup.
Moving on to Part 2. Smart money versus retail. Gavretti bases this major structural warning on the commitments of traders' data, which is really the ultimate footprint of institutional positioning. Let's look at the commercials first. These are the smart money hedgers. They are pinned to the absolute floor at 0, aggressively scaling in to negative 2,566 net shorts. Now compare that to the large specs, the trend followers. They're pinned to the absolute ceiling at 100, just stubbornly holding positive 5,078 net longs. This is extreme polarization, guys.
When we track the raw contract numbers, it completely reveals the smart money's true intent. Look at the commercials. They are actively making lower lows, expanding their net short exposure right into this decline. They have absolutely zero interest in catching this falling knife. Meanwhile, the large specs are out there making higher highs, actively buying the dip, and getting totally trapped.
And this brilliantly illustrates exactly why their commercials are so confident in stacking up those shorts. They're looking at intermarket fair value. While Bitcoin is sitting right around fair value against the US dollar and 30-year bonds, it is still heavily overvalued against gold, reading at 77.61. Because Bitcoin is fundamentally overvalued compared to gold, institutional players have no real fundamental incentive to step in and provide a safety net. So the runway is totally clear for them to just keep pressing the downside.
That brings us to Part 3, the dead cat bounce.
This is the exact face-ripping trap Gavretti is warning us all about. For those who might need a quick refresher, a dead cat bounce is a temporary, short-lived recovery of asset prices from a prolonged decline, which is inevitably followed by, you guessed it, a continuation of the downward trend. It looks like the bottom is in, but man, it's just a total mirage.
Now, what's really interesting about Gavretti's own notes is that they scream one thing: oversold. The daily chart right now is acting like a violently stretched rubber band. The immediate downward thrust is structurally just running out of gas.
And the daily indicators completely back this up. Thomas D. Mark counts, which track trend exhaustion, are printing 8s, 9s, and moving into 13 countdowns. Plus, momentum oscillators like the Williams %R and slow stochastic, they're buried well below their thresholds and are physically beginning to hook up. The tape is practically demanding a bounce. But crucially, the Williams Progo, which measures professional buying, is deeply negative at -922. What does this mean for us? It means professionals are actively distributing into this decline, right while retail blindly buys the dip.
All right, Part 4, sell the relief rally. So we basically have two totally conflicting realities right now. We've got a micro setup screaming for an immediate bounce to relieve downside compression, and that is colliding head-on with a macro gravity engineered for much lower prices. Gavretti's thesis is simple: you cannot trust this coming rally. The commercials are absolutely going to use it to reload their shorts at even better prices.
Because of that, the tactical play isn't to buy the bounce, it's to weaponize it. You wait for that daily momentum hook in the Williams %R to cycle up, fail, and then roll over. That right there is your trigger. You sell into it, riding right alongside the commercials against those trap trend followers.
Let's move to Part 5 and see how this all builds to the 5-week structural bottom. Exactly 5 weeks.
The true seasonal clock dictates a heavy downward to sideways gravitational pull through mid to late July. That cyclical trough is exactly 5 weeks out from Gaverty's call. Time is simply not on the side of the bulls right now.
But Gaverty is extremely disciplined here. He frames this as an all-in checklist, and he refuses to blindly buy the macro dip until his structural indicators flash a definitive green light. He actually requires 3 things to happen simultaneously roughly 5 weeks from now. First, the true seasonal cycle must hit its bottom. Second, he needs a perfected weekly TD9 buy setup or a full 13 countdown to print confirming structural exhaustion. And third, this is big, the raw commercial net positions must stop making lower lows and aggressively hook upward, proving the smart money is finally accumulating.
So, the crucial point is, to survive and actually profit here, Gavrity relies on a ruthless 4-step action plan. Step 1. Anticipate the dead cat bounce. It's a trap, don't fall for it. Step 2. The tactical entry. Wait for the rally to fail and sell into it. Step 3. The macro target. Ride those shorts all the way down to the seasonal trough as the trend followers completely capitulate. And Step 4. The ultimate reversal. Wait those 5 weeks for the structural alignment of time and data before you finally back up the truck to buy. Until then, make no mistake, the smart money controls the downside.
So take a look at your own portfolio and your own strategy right now. Will you take the dead cat bait just because the micro daily action looks cheap? Or will you respect the massive macro structural gravity, let the trend followers get liquidated, and wait out the 5-week clock right alongside the smart money? The data is crystal clear. The choice is yours. Thanks for joining me on this explainer, and as always, keep your eyes on the tape.